let's deal with the sort of short term before we get a bigger picture view. And I'll start with the jobs data that we're expecting to see. Wednesday's ADP led many to anticipate the worst 6 months. Well, the ADP number showed the worst 6 months in terms of the jobs market since 2010. Are we going to see something similarly weak today, do we think?
Well, it's difficult to call, as you know, each data point is difficult. But what's happening with the incoming data today, it's a reflection of last year's over-tightening. And you know that monetary policy works with a lead and a lag.
Yeah.
So it is a fact now that the Fed over-tightened. That's not an opinion. At the time, it was an opinion, but we're looking back and they've reversed the hikes. They've cut 3 times. They've been reversing the balance sheet shrinkage as well. So that's not really a question of whether or not they over-tightened. So now the incoming data is reflecting that. And what concerns me is the risk of double counting. So if we respond too aggressively to soft data today, are we double counting? And to me, it validates the valuations. It doesn't necessarily mean we're going to change our forecast because of one data point. So to me, it's consistent with lower yields for a long time.
So you suggest that they've already cut rates to deal with a worse employment situation, so they don't need to do it again?
I think the cuts acknowledge the mistake. Not that anyone's going to put their hand up and say sorry, but the cuts acknowledge the over-tightening, and exactly the data that's coming in now reflects what was happening last year.
Okay, Matt.
So what do you think? I mean, you say it's a fact and not an opinion that they over-tightened. What were the results of that? Because we still see unemployment at less than 4%. I mean, the lowest level it's been since 1969. I don't know what you were doing in 1969, but I wasn't doing very much. And we still have, no recession. There's still growth in the U.S. economy and positive rates, unlike many of the other developed nations around the world.
Yeah, well, I'm trying to work on a forward basis, Matt. So if we had been discussing this time last year, which I believe we were, when yields were virtually double the current level in the US, way above 3%, most of your guests would have been arguing for 4%. To me, that was the over-tightening. It is a fact because the hikes of last year are being reversed. So it's no longer an opinion. To me, the data in a year's time will look different. So I'm not going to react to the incoming on a monthly basis. The thing about bonds is correctly weighting those cyclical drivers, the near-term data points like the Chicago PMI or the data coming in from China, is weighting those against the longer-term structural drivers. And to me, the failure of mainstream forecasting has been to underestimate the longer-term structural drivers, excess debt, demographics, wealth inequality, etc.